Stop refreshing silver price charts. Stop checking Reddit forums. Stop listening to mainstream analysts tell you silver is just another commodity. Because right now, at this exact moment, we need to be looking at something else entirely. We need to be looking at Washington, D.C. We need to be looking at Beijing. And we need to be looking at what just happened 72 hours ago that has short sellers in an absolute state of panic. Today is February 5th, 2026. And I'm going to show you exactly why JD Vance's latest policy revelation is not just another political talking point. It's not campaign rhetoric. It's not a trial balloon. It is the smoking gun that confirms what we've been saying for months. The United States government is about to establish a price floor for silver. And when I show you the numbers coming out of China right now, when I show you what's happening in the derivatives market, when I connect these dots for you piece by piece, you're going to understand why $1,000 silver isn't a fantasy. It's a mathematical inevitability. Let's talk about what JD Vance actually said. February 2nd, 2026. Senate Banking Committee hearing, buried in a 3-hour session that most Americans didn't watch. Vice President Vance was asked a simple question by Senator Warren. Will this administration consider strategic mineral reserves beyond oil? And here's what he said. I'm going to quote this directly. Silver is not just a precious metal. It is a strategic defense asset. It is a technological necessity. And yes, we are actively exploring mechanisms to ensure domestic price stability for critical minerals, including, and I want to be very clear about this, including silver. Let me repeat that last part. Including silver. Now, the mainstream media buried this. CNBC didn't cover it. Bloomberg gave it one sentence. The financial press completely ignored it. But do you know who didn't ignore it? The short sellers. Do you know who didn't ignore it? The bullion banks who have been suppressing silver prices for decades through paper derivatives. Do you know who didn't ignore it? China. Because within 18 hours of Vance's statement, we saw something extraordinary happen in Shanghai. But I'm going to come back to that. First, I need you to understand what price stability mechanisms actually means in government speak. When a government says they want price stability for a strategic asset, they're not talking about keeping prices low. They're talking about establishing a floor, a minimum price below which they will not let the market fall. Why? Because if silver drops too low, domestic mining becomes unprofitable. Mines close, production stops, and suddenly you're dependent on foreign suppliers for a metal that goes into every single guided missile, every radar system, every solar panel, every electric vehicle. The Department of Defense has been screaming about this for 2 years. Silver is in 95% of all military electronics. The Pentagon cannot afford to let American silver production collapse. So what does a price stability mechanism look like? Option 1, direct purchasing. The government buys silver at a set minimum price, always. Option 2, strategic reserve mandates. Requirements that certain industries must source from the strategic reserve at guaranteed prices. Option 3, export controls and import incentives that create an artificial price floor. We don't know which mechanism they'll choose yet, but here's what we do know. When Vance said we are actively exploring, that's not future tense. In Washington, exploring means we've already decided and we're working out the details. And the short sellers know this. Now let's talk about what happened in Shanghai, February 3rd, 2026. 9:47 a.m. Shanghai time, exactly 18 hours after Vance's testimony. The Shanghai Gold Exchange posts silver prices at $93 per ounce. Let me repeat that, $93, while New York COMEX silver is trading at $30, while London is at $31.50. Shanghai silver hit $93. Now, before you say that's just a premium, that's just Chinese demand, let me show you why this is different. The typical Shanghai premium over London spot is 2 to 3%. Sometimes, during high demand, it goes to 5%. This wasn't 5%. This was a 190% premium. Shanghai silver was trading at nearly 3 times the Western paper price. Do you understand what that means? That means physical silver in China has completely decoupled from the paper derivatives market in New York and London. Let me explain what's actually happening here. Chinese buyers aren't stupid. When they heard Vance's statement about price floors, when they heard the United States government is about to intervene in the silver market, they did the math immediately. If the U.S. establishes a price floor, right, let's say it's $50 or $75 or $100, what happens to global prices? They rise to meet that floor immediately, because silver is a global commodity. If America won't let it trade below $75, then global spot prices will adjust to that new reality. So what did Chinese industrial buyers do? They panic bought physical. They pulled every ounce they could find off the Shanghai exchange. They're willing to pay $93 today because they know that in 6 months, $93 might be the baseline, not the premium. But here's the part that should absolutely terrify the short sellers. This wasn't retail investors. This wasn't Chinese gold bugs stacking coins. This was industrial offtake, solar panel manufacturers, electronics companies, battery producers. These are the companies that use thousands of ounces per month. And they just bid silver up to $93 because they'd rather pay the premium now than face supply shortages later. The Shanghai Gold Exchange reported that 41 tons of silver were withdrawn for physical delivery in a single day. 41 tons. That's 1 at 318 to 186 troy ounces. That's more silver than most mining companies produce in a month. And it disappeared into Chinese industry in 24 hours. Now, I need you to think about this from a global supply perspective. Annual silver mining production is about 830 million ounces. Sounds like a lot, right? But industrial demand is already at 650 million ounces. Investment demand is around 200 million ounces. We're already in a deficit. The market is already underwater by about 20 million ounces per year, met by recycling and government stockpile releases. Now imagine China starts pulling an extra 500 tons per month because they're front-running a US price floor policy. Imagine India does the same. Imagine European manufacturers start hoarding because they see what's coming. Where does that silver come from? It comes from one place: the short sellers, the bullion banks who have sold paper silver contracts representing ounces that don't exist. And that's why they're panicking. Let's talk about what's happening in the derivatives market right now. The COMEX silver futures market is a beautiful scam. I'm going to explain exactly how it works. A bullion bank, let's say JP Morgan, let's say HSBC, they sell a futures contract. That contract represents 5,000 ounces of silver. But here's the trick. They don't have to own that silver. They just have to post a small margin, maybe 10-15% of the contract value. So they sell paper promises of silver that doesn't exist in their vault. They sell hundreds of contracts, thousands of contracts. The COMEX currently has a paper to physical ratio of approximately 250. That means for every actual ounce of silver in COMEX warehouses, there are 250 ounces worth of paper claims against it. This works fine as long as nobody asks for delivery. 90% of futures contracts are cash settled. Traders just take their profit or loss in dollars. They never ask for the metal. But what happens when people start asking for physical delivery? The whole system breaks. And that's exactly what's starting to happen. In the last 30 days, COMEX silver delivery requests have increased by 340%. Let me say that again. Delivery requests are up 340% in a single month. Traders are standing for delivery. They're saying, I don't want cash settlement, I want my silver. And the banks can't deliver it because it doesn't exist. Now, combine this with the Vance revelation. If the US government is about to establish a price floor, let's say 75 per ounce, what happens to a short seller who sold contracts at 32? They have to either deliver physical silver that they don't have, or they have to buy it back at the new market price to close their position. If they shorted 10,000 contracts at $32 and they have to cover at $75, that's a loss of $43 per ounce times 50 million ounces. That's a $2.15 billion loss on a single position. And we're not talking about one bank. We're talking about the entire precious metals derivatives complex that has been shorting silver for 20 years. The total short interest in silver derivatives is estimated to be around 900 million ounces if they have to cover at higher prices, if a price floor forces them to close positions, if delivery demands accelerate. We're talking about potential losses in the hundreds of billions of dollars. This is why you're seeing panic. On February 4th, yesterday, COMEX silver volatility hit levels we haven't seen since March 2020. Options traders are buying protection. They're pricing in massive price moves. The market knows something is coming. The short sellers know they're trapped, and the trap is about to snap shut. Now let's talk about why $1,000 silver isn't just possible. It's probable. I'm going to walk you through the mathematics, and I need you to follow me carefully. Start with supply and demand fundamentals. The world uses approximately 1 billion ounces of silver per year. Mining produces 830 million. We're already short 170 million ounces annually. That deficit is currently met by government stockpile releases, recycling, above-ground inventory drawdowns. But those sources are finite. The U.S. National Defense Stockpile sold off most of its silver in the 1990s and 2000s. It's nearly empty. Recycling can't scale fast enough to meet industrial demand growth. Above-ground inventories in COMEX warehouses have been declining for 18 months straight. Now add the new demand factors, solar panels. The solar industry is projected to use 250 million ounces per year by 2030. That's up from 140 million today. Electric vehicles. Each EV uses 25 to 50 grams of silver. Global EV production is scaling exponentially. 5G infrastructure. Every 5G tower uses 3 to 5 ounces of silver. Defense spending. With global tensions rising, military electronics demand is surging. And now, add the speculative demand. If the US government announces a price floor policy, every investor on Earth will want silver exposure. Pension funds, hedge funds, sovereign wealth funds, they'll all want in. Bitcoin went from $10,000 to $69,000 in 18 months during the 2021 bull run. That was pure speculation on a digital asset with zero industrial use. Silver is both an industrial metal and a monetary asset. If investment demand increases by even 50% of the Bitcoin 2021 inflow, we're talking about an additional 300 to 500 million ounces of demand. Now do the math. Current annual supply, 830 million ounces. Current annual demand, 1 billion ounces. Deficit, 170 million ounces. Add solar growth. Plus 110 million ounces demand, add EV growth. Plus 180 million ounces demand, add investment surge. So 400 million ounces demand. New total demand, 1.59 billion ounces. New deficit, 760 million ounces per year. There's no possible way to meet that demand at current prices. Prices have to rise until 1. New mines become profitable and open. 2. Demand is destroyed by high prices. 3. Recycling scales up dramatically. How high do prices need to go to achieve that? Historical analysis shows that new primary silver mines need prices above $40, $50 to be profitable. But we're not talking about equilibrium prices. We're talking about a short squeeze combined with industrial panic buying combined with government intervention. In that scenario, $1,000 per ounce is not only possible, it's conservative. Let me connect all the dots for you in a timeline. January 15th, 2026. Department of Defense releases classified memo warning of critical silver supply vulnerabilities. January 28th, 2026. Chinese industrial firms begin quietly increasing silver purchases on Shanghai Exchange. February 2nd, 2026. JD Vance testifies before Senate, reveals price stability mechanism, exploration for strategic minerals including silver. February 3rd, 2026, 9:47 a.m. Shanghai time. Silver prices spiked to $93 on Shanghai Gold Exchange. 41 tons withdrawn for physical delivery. February 4th, 2026. COMEX delivery requests surge 340% month over month. Volatility spikes to 2020 crisis levels. February 5th, 2026. Today, right now. As I'm recording this, do you see the pattern? Do you see how every piece fits together? This isn't conspiracy theory. This is a coordinated sequence of events driven by industrial necessity and geopolitical strategy. The U.S. cannot afford to lose its domestic silver production capacity. China cannot afford to be caught short when prices spike. Short sellers cannot afford to maintain positions if a price floor is established. And industrial users cannot afford to wait for prices to normalize because they won't normalize. This is what a market dislocation looks like in slow motion. Most people won't recognize it till it's too late. Most people will wait for confirmation from CNBC or Bloomberg. Most people will watch silver go from $32 to $50 and think, it's too expensive now, I'll wait for a pullback. And that pullback will never come. Because once a government price floor is established, once China's industrial hoarding goes into full effect, once the short squeeze begins in earnest, there is no going back. The question isn't whether silver will reach $100 or $500 or $1,000. The question is, which side of this trade will you be on? Will you be the person who listened to mainstream analysts telling you silver is overvalued at $35? Or will you be the person who understood the fundamentals, who saw the political signals, who acted before the window closed? If you own physical silver right now, in your possession, in a vault you control, do not let it go. I don't care if it hits $50 and you're up 50%. I don't care if it hits $100 and everyone tells you to take profits. You're not holding a commodity. You're holding a strategic asset that governments are about to fight over. You are holding industrial feedstock that manufacturers are panic buying. You are holding the physical metal that will break the backs of short sellers. If you don't own silver yet, if you've been waiting for the right time, I'm telling you right now, this is the right time. Not next week, not next month. Not when CNBC confirms what I'm telling you today. Now. Because the Shanghai premium is a warning shot. Because Vance's testimony was not an accident. Because the short seller panic is not a drill. I've been analyzing precious metals markets for over a decade. I have never, and I mean never, seen a setup like this. Every indicator is flashing red. Every signal is pointing to the same conclusion. A massive repricing event is coming. And when it hits, when silver goes from $32 to $93, not just in Shanghai, but globally, when $1,000 becomes the new reality, the only people who will benefit are the ones who positioned themselves before the event. You are watching history unfold in real time. The smart money bought their insurance before the fire started. They didn't wait for the smoke. They didn't wait for the flames. They saw the spark and they acted. This is Bullion and Beyond. If this analysis helped you understand what's really happening, hit that like button. Subscribe if you haven't already. Share this with everyone who needs to see it. The clock is ticking, and the window is closing.